Insurance. Insurance is understanding risk management, managing your risk. After this segment, you'll have a better understanding of how to manage risk. We're going to look at some major areas that you need to have insurance coverage for, and we're going to talk about the different types of coverage within each one of those areas of insurance. Insurance. Things we're going to look at in this segment: understand risk management. We're going to identify major areas for insurance coverage and identify different types of coverage within those areas of insurance. What is insurance? Insurance is all about risk management, managing the risk. The purpose we have insurance is to prevent financial loss. Insurance is available to prevent financial loss. It's not about how much are we going to collect when we file a claim, but it's recovering from a financial loss. The way that works, the insurance company assumes the risk for you, and that's the risk of financial loss. You pay the company a premium, and if you incur that loss, then the insurance company covers that loss or prevents your financial loss. The insurance companies have to determine the likelihood of experiencing a loss and how much each of those losses might cost them. So insurance companies base those numbers on the concept of large numbers. Let me give you an example. If I were to have 1,000 people in my town who each just happen to own a $100,000 home, and they all wanted to insure those homes. If I look at my statistics, I believe that about 5 of those 1,000 homes will be destroyed in the course of the next year. So for $500, I can insure 1,000 homes. I will then have collected $500,000. Remember, 5 homes at $100,000 apiece would be my $500,000. I can now cover those 5 losses. In the meantime, I, as the insurance company, can actually invest that $500,000. Now, we all realize that every home is not insured for $100,000. Every home is not the same. So based on variations, the type of home, the location of the home, and the replacement cost of those homes, each individual will probably pay a little bit different amount in their premium. Now remember, the insurance company doesn't know which 5 homes are going to be destroyed. So they need the large numbers to collect all the premiums. Some things we need to understand about risk management. What is risk? Risk is an unpredictable chance of loss or injury. Remember, they can predict that about 5 homes will be destroyed, but they don't know which 5 will be destroyed. So it's actually unpredictable. A hazard. A hazard is anything that increases the likelihood of a loss. What are some examples of a hazard? Maybe bad wiring in your house, or icy conditions on the road. Do icy conditions result in an accident? Well, indirectly, yes. Those are the hazards. They increase the likelihood of a loss. The peril is anything that actually causes the loss. So let's go back to those icy conditions. The icy conditions did not cause a loss. It was the accident that resulted from the icy conditions that caused the loss. Bad wiring in my house? No loss. But that bad wiring increases the likelihood of a fire. A fire would cause a loss. Therefore, the fire is the peril. Now, insurance companies insure the perils. So when you're looking at a policy, you want to know or understand which perils are actually covered. Liability is the legal responsibility for someone's loss. If the icy conditions result in an accident, I'm at fault, I'm responsible for the loss to someone else's vehicle that I may have hit. If my son throws a baseball through the neighbor's window, I'm responsible for his actions, and I would be responsible for that loss. Remember, perils are what the insurance companies insure. Now, there are perils out there all the time. There's hazards out there. Our goal is to actually manage the risk. Risk management. That's what we're talking about. What we need to focus on is managing that risk. Let's use the scenario of you coming to school today. You took a risk by coming to school. You could have been involved in an accident. So how are we going to manage that risk? The first thing you could have done is avoided the risk. If you didn't come to school today, there was virtually no chance you're going to get involved in an accident on your way to school. So you would have avoided the risk. Avoiding risk is not always possible. So another thing we can do is reduce the risk. How do you reduce risk? Well, using our example of coming to school, you could leave a little bit earlier to give yourself some time so you're not rushed. Make sure you put your seatbelts on. We can avoid the busiest streets or roads on the way to school. We drive the speed limit, maybe even a little bit slower. Those are things that we can do to reduce the risk. You can do all those things. That doesn't mean you're going to avoid the accident, but the likelihood of being involved in an accident have went down. We could assume the risk. We can say, well, you know what happens, happens. We take the chance, assume the risk, and we go with it. If we get involved in an accident, that's the chances we take. Now, when we're talking about the insurance piece of using insurance to manage our risk, we can assume part of that risk. You might decide you don't want insurance and assume the risk. You might decide you want to assume part of the risk and buy insurance for part of the loss. So the fourth way is to shift the risk. You can shift the risk to the insurance company. Shift the risk of that financial loss to the insurance company. The part we assume is the part of the risk that we retain. That might be the deductible, or that might be by not having insurance at all. We'll look at automobile insurance here in a little bit. You might decide that I'm going to insure my loss by hitting someone else, but I drive an old car and I'm going to assume that risk myself. So if I damage my car, I have to pay for it. What I'm talking about is your collision coverage. You might decide that I'll assume $500 worth of risk on my car. Anything greater than that, I'm going to shift the rest of that loss to the insurance company and buy insurance. So the one that we're going to be focusing on here is shifting the risk of that financial loss to the insurance company. And we'll talk a little bit about assuming some of that risk ourselves. Some types of insurance or areas of insurance that I want to address today. Property. Some property that we insure is our automobile, our home, and our personal possessions. We have liability insurance. I talked about what liability is, something that we might be responsible for. There's health insurance. We'll touch on health insurance, and we'll talk about life insurance. Let's first take a look at property insurance. Property insurance, I'm talking about insuring your home and everything that's in it, the structure, versus what's inside it, the building itself versus what you have inside it. If you own the building, you need insurance. Now, most of you, if your parents or if you own a home, your parents have insurance on that home. The bank actually makes sure that that happens. If you own the home yourself, you would have to go out and make sure that you have the insurance. What if you don't own the structure? Well, if you own the contents inside that home, you need insurance. So if you're renting an apartment, you don't actually own that building, but you own everything inside it. The furniture is yours. The clothes are yours. The games are yours. The DVDs are yours. The stereo, everything that you own are your contents. If that apartment were to be destroyed, could you absorb the financial loss that it would take to replace all of your personal possessions? If you can't absorb that cost, you would need what we refer to as renter's insurance. If you own the building, you'd be looking at insurance on that structure. Now, how much insurance do you need? Well, you need enough to replace the property. So if you have $1,000 worth of possessions, I guess you could get by with $1,000 worth of insurance. I would encourage you, go through all your possessions and put a value on each one of those. What would it cost you to replace everything that you own? Off the top of your head, you probably wouldn't remember a lot of the things you own. But when you get home, take a look at all the possessions that you have. What would it cost you to replace that property? That's how much insurance you need. Less your deductible. You have to pay the deductible. That's the part of the insurance or the risk management that you assume. You might have a $1,000 deductible. You might have a $100 deductible, somewhere in between. The deductible is the amount that you agree to pay before the insurance company reimburses you. Automobile insurance. There's 5 types of coverage within automobile insurance. We have bodily injury liability. Liability is what you're responsible for. Bodily injury implies someone was injured. So you have the liability that you're responsible for personal injury. You have the liability you're responsible for property damage. That would be the car that you hit, the light pole you took out, the building you ran into, any type of property. There are medical payments that need to be taken care of. I'll talk about those. Those are actually the medical payments for you and the people in your car. The collision coverage would be the coverage on your car. So we have property damage for the other car and collision coverage for your car. And the last type would be comprehensive. Let's take a look at the bodily injury liability. Most states have a minimum liability that you're required to carry on your vehicles. If you drive, you must have a minimum amount of insurance. An example of that would be what I've got here, 25, 50, 10. What do those numbers mean? Well, the 25 refers to $25,000 per individual per accident for bodily injury. So if I get involved in an accident, someone gets hurt, their medical bills are covered up to $25,000. If someone spends a long time in the hospital and has more than $25,000 worth of bodily injury, anything over the liability amount I have, I will be responsible for. So if this is my coverage, I have $25,000. If someone has a $30,000 medical bill, my insurance company will pay $25,000 and I'll be responsible for the remainder. The $50,000 per accident for bodily injury. So I had $25,000 per individual. Now I have $50,000 per accident. So if there's 2 people, we can go up to $25,000 apiece. If there's more than 2 people, we still can go up to $25,000 for each individual, but no more than $50,000 for a total. So if we have 1 or 2 serious injuries and then some minor injuries, we might start running out of money. Remember, anything over the $50,000 limit, you would be responsible for. The $10,000 per accident is for property damage to someone else's property. That'll be the car that I ran into, the light pole I took out, or any other damage to actual property. Now, if you're thinking 25, 50, 10 doesn't sound like a whole lot of coverage, $10,000 worth of damage to someone's car, that may not repair their car. $25,000 per individual in a serious accident may not be enough. So insurance companies offer variations of those numbers. Here I've shown you another example, 250, 150. Now we're up to $200,000 per individual, $500,000 per accident, and $150,000 for someone else's property. So again, I talked earlier about how much insurance do you need. Well, I said earlier to replace your property. What's it going to cost to replace someone else's property? Not knowing what type of property may be involved in the accident, we need to make sure we're covered well enough to protect our assets. If I have some savings, I have retirement accounts, and I get involved in an accident, would it be fair to assume that some lawyer is going to try and go after my assets? Probably. So I would want to make sure I had enough liability coverage to protect myself and realistically protect the people or property that I may hurt. I mentioned medical payments earlier as a type of insurance. Well, the liability pays for the bodily injury for the other people. The medical payments coverage provides coverage for medical payments for you and your passengers. So these are the people in your vehicle. If you have good health insurance may pick up this as well. If you're involved in an automobile accident, most health policies require you to file a claim with your automobile insurance first, and then they will pick up as a second insurance. So depending on the health coverage you have, medical payments may or may not be real important. The collision coverage. The collision coverage covers the damage to your vehicle. This is where I mentioned you may have a deductible. Actually, you probably will have a deductible. You're responsible for the deductible, and if you choose to have collision coverage, the insurance company would then pay to repair your vehicle up to the value of the vehicle. If you have a $10,000 vehicle and it's going to cost $12,000 to fix it, they're probably going to tell you it's only worth $10,000 and they're going to buy the vehicle from you. The comprehensive insurance covers non-accident situations. If a tree fell on your car, you ran into a deer, or actually a deer ran into you. Some things that don't involve other vehicles and involve no negligence on your part would be considered comprehensive. Let's talk a little bit about health insurance. Health insurance has been going through a lot of changes recently. One of the most insurance policies will fall under 2 types, either a preferred provider organization or a health maintenance organization. Let's talk a little bit about the PPO, or the preferred provider organization. A PPO is a group of doctors that enter into an agreement on the rates with the insurance company. So your insurance company negotiates with doctors and hospitals and agrees that every time you go to the emergency room, they agree to pay this much money. If you have a particular surgery, they pay a set fee. So the group of doctors have agreed with the insurance company on the rates. A health maintenance organization is an insurance plan that provides certain types of health care for a prepaid premium. You agree to pay the premium, and the doctors, the clinic, will provide certain types of health care based on those premiums. There might be a small copay with that, but generally speaking, they've already agreed to cover those expenses. So with an HMO, if I go in, I don't care how much the doctor is charging, because if it's a covered procedure, that procedure is already covered. Under preferred provider organization, I need to make sure I'm dealing with a group of doctors that are in agreement with my insurance company. So there may be multiple doctors that I can go to within that organization. Under an HMO, I have a designated doctor, and my doctor can refer me to people that are also part of that HMO. But under the HMO, everything goes through my primary doctor. Because we're paying a set fee and all these services are provided, HMOs tend to be more preventive, because if they prevent future problems, then they never have to deal with them. Whereas under the PPO, whether it's preventive, routine, or something serious, they've agreed on what the cost is, and they just go ahead and charge the insurance company or us that amount. There are a couple of government programs out there. Medicare provides care for the elderly. Medicaid provides aid for the poor. So those are insurance programs that are handled through the government. A couple things you need to understand when talking about health insurance. The deductible is an annual amount. So under my preferred provider organization, I may have a $1,000 deductible. I need to pay the first $1,000, and then my insurance will pick up anything after that. A copay is paid each time. Copays are more familiar with HMOs, where you may have a $10 or $15 copay every time you go to the doctor, but everything that you do there is covered. So the copay is the amount you pay each time. The deductible is an annual amount that must be met. Once that deductible is met, if there is a copay, you would still be paying your copay, but the deductible has been met, so the insurance company is picking up the cost. When dealing with health insurance, you need to be familiar with the types of coverage. What is actually covered? Are hospital stays covered? Is surgery covered? Prescriptions? Physicians? Each one of these are different types of coverage. If all you have is hospital coverage and you go to your doctor for a sore throat, that's not going to be covered. If you have physician coverage and you go in for surgery but didn't have surgical insurance, your surgery is not going to be covered, or your hospital stay is not going to be covered. Each one of these areas are different types of coverage. So when looking at your health insurance, you need to make sure that each one of these are covered, or the coverages that you intended to have covered are covered. Let's talk a little bit about life insurance. There are basically two types of life insurance. Life insurance can be categorized as permanent or whole life, or temporary insurance, which is also known as term. Permanent or whole life provides a lifetime of coverage at a guaranteed price. So if I buy permanent insurance, The price that I'm paying will be the same now and in the future. So if I buy my insurance when I'm 20 years old, I lock in a price based on that age and health. That price will stay the same as long as I retain or keep that policy. Permanent insurance may accumulate a cash value. Now, when I compare this permanent to the temporary, if I look at a 20-year-old buying the same amount of insurance with the same health conditions, permanent insurance will be more expensive. But keep in mind that price is locked in all the way through as long as you keep that policy. So as you get older, you're still paying that price that you paid when you were 20. The cash value comes from the money that is basically collected up front. They're actually charging you more than the insurance costs when you're young and building up a cash value to help cover the expense of the insurance when you get older and the actual cost of insurance is more. What's nice about a cash value is if you decide to cancel the insurance, you get the cash value back to you. If you ever needed to borrow money, you can actually borrow the cash value. Now that's borrowed against your insurance, so when it comes time to settle your insurance claim, you will not get your full policy if you have a loan against the cash value. But that is a benefit that is out there for permanent insurance. The other type is temporary or term. Temporary insurance covers a specific term. That might be 1 year, 5, 10, 20. You can buy term for whatever term you want. The disadvantage of the temporary insurance is that the price changes with each term based on your age and health. So if you're 20 and you buy a 5-year term policy, you're 25, 5 years later, and decide you're going to renew that policy, you're actually buying a new policy for another 5 or 10 or however long a period of time you want, but you're now 25 years old. Insurance is more expensive for a 25-year-old than it is for a 20-year-old. Why? Well, the likelihood of a 25-year-old dying is greater than a 20-year-old. The older you get, the more likely it is you'll die. So as you get older, the insurance becomes more expensive. So let's go back to that permanent policy that you bought at age 20. That price has been locked in, and now you're 60 or 70. What is the likelihood that a 70-year-old will die? Probably quite a bit higher than that 20-year-old, right? So if you're buying temporary insurance when you're 70, imagine how expensive that insurance will be. Most people who buy temporary insurance reach a point in their lives where the insurance is too expensive and they no longer buy it. People who buy permanent insurance are reluctant to pay for it when they're young because it's more expensive. But if they maintain that policy, when they get older, they realize what a bargain they have. So permanent insurance for your whole life, one price, whether you're paying a monthly premium or an annual premium, whatever that premium is, that will stay the same as long as you keep making the payments. Temporary insurance covers a specific period of time. A year, 5 years, 10 years, 20, 30. You can buy it for various lengths of time. Each time you buy it, that price will change. Now, if you buy a 10-year policy when you're 20, the price will stay the same for that whole policy. But it'll probably be more expensive than someone who bought a 1-year policy. There is no cash value. When the term ends, the insurance is over. There are no benefits to having temporary insurance. There are some variations of those two types. There's universal insurance. There's variable insurance. Universal is basically a combination of temporary insurance with the investment piece that permanent insurance gives you. They take part of your premium and actually invest it so that that can help pay for premiums in the future. It helps keep your monthly costs down over the long term. Variable allows some variations in your policy, allows you to make changes. Group life insurance is generally term insurance, and it is offered to a group of people. That group might be an employer. All employees are entitled to buy a group insurance policy. Now, if all employees are entitled to buy it, that means we're including people regardless of their age, regardless of their health situation. Because we get a larger number of people involved, generally the price will be lower. Remember the purpose of insurance. It is protection from financial loss. So tie that to life insurance. How do you lose financially by dying? Well, anyone who's dependent on your income would suffer a financial loss if you were to die. So let's think about how much insurance we need. First thing we want to do is assess the need. What need is there for insurance? Or what are the potential financial losses that you might suffer? Ask yourself who is financially dependent on you and what expenses will they incur. Anyone who might be living off of your income is financially dependent on you. If you have no one financially dependent on you, do you still need insurance? I would say yes, because there are always going to be expenses when you die. We'll take a look at some of those expenses in a minute here, but final expenses, whether someone's dependent on you or not, it's going to cost money to have a funeral. Do you want to burden someone else with that expense, or is that an expense that you want to take care of? The other thing to keep in mind when thinking about buying insurance, insurance is based on, the price of insurance is based on your age and your health. You're young, you're healthy, you don't need insurance, you're going to live forever. Well, if you buy insurance now, you have the protection. Because in reality, you probably won't live forever. Do you want to wait 10, 15 years from now and find out you have some terminal illness and then buy insurance? What do you think the insurance company will say when you go in and say, well, I have cancer, but I'd like to buy some insurance? They understand the likelihood of your dying is significantly greater than someone who's healthy. They may even tell you, sorry, we're not going to insure you. It may be too late to get insurance. So, what type of insurance do we need? Permanent or temporary? Ask yourself, of those needs, what needs are permanent? What needs are temporary? Let's take a look at a sample needs assessment here. I've come up with some figures. They may or may not be accurate. They may work for some of you, they may not work for others, but I think it'll get the point across. Final expenses. I haven't checked recently what a funeral costs, but let's say it costs about $10,000 to get everything taken care of. That's one need that someone is going to have to take care of financially when I die. And that's a permanent need. Those final expenses are going to be there whether I die tomorrow or 20 years from now. Credit card debt. I've not been a good credit card user. I've run up some debt. If I die, and since my wife is on the account, she's going to be responsible for that credit or that debt. Do I want her burdened with that? That's a financial loss that she will experience if I'm no longer paying that. Now, I've made that a temporary expense because very shortly I hope to have that paid off. Not sure how shortly. We'll talk about the length of the temporary need in a little bit. I have a mortgage. My mortgage is $120,000. My mortgage will eventually be paid off. So I'm calling that a temporary debt, but depending on my situation, that might be kind of long term. So I may want to consider that one separately. But on the mortgage, do I want that to be paid off, or am I going to leave my family responsible to continue paying that mortgage? If I want it paid off, then I need to include that as part of the need. I've been saving money for my children's college fund. I want $50,000 there for them. That's a temporary need, because once they go to college, we don't need that money anymore. We'll have spent whatever I've saved, and there won't be a need for it once they've completed college. I have a car loan. I owe $8,000. Again, do I want my family to have to keep making that payment? Or, that's a secured loan. Do I want the bank to come and take my car away? So there's an $8,000 need that needs to be taken care of. Medical expenses. Is it possible that I could have some medical expenses that lead up to my death? I've decided to put $50,000 in my need for medical expenses. That will cover whatever medical expenses I may incur in the later stages of my life that insurance doesn't cover. I've made that a permanent need because there's the possibility that I may have those medical expenses at the end of my life, regardless of when that time comes. Readjustment. I've put some money in there in my need for my family to readjust without me. Some families are going to move after the death of, especially if it's the death of a breadwinner. They may move back to their family. They may move to get a new start. Some people will take time off work to recover and readjust. This provides some money to get through that readjustment period, whatever that may be. Again, nothing magical about that number. That's a number that I'm comfortable with. So there's the needs that I've come up with. Might you have other needs? Sure. Go through your needs assessment and identify how much insurance coverage you believe you need based on the needs. Now, I've come up with a need of $343,000. $160,000 of that is permanent. Those needs will be there regardless of when I die. There's $63,000 worth of needs that are temporary, and my mortgage, which is $120,000. I told you I wanted to keep that one separate. So, what type of insurance coverage do I need? Well, based on these needs, I think it would be appropriate to go buy a $160,000 permanent policy. There's also a $63,000 temporary need. Now, how long is that need? I've got the credit card debt, I've got the college fund, and I've got the car loan. In 5 to 10 years, will most of those temporary needs go away? They might. So what I might be looking at is a 10-year term policy. And then I've got my mortgage. How much time do I have left on my mortgage? When do I anticipate paying that mortgage off? If I anticipate paying that off in 5 to 10 years, I can include that with my other temporary needs. If I'm sitting on a 20 or 30-year mortgage, that would give you an indicator of how long you might want to have that term coverage for. Now, keep in mind that term the mortgage will be going down in value as you pay that off. So you certainly won't need the $120,000 for the entire 30 years. So maybe you could split that up. Maybe get a $50,000 or $60,000 policy for the full 30 years and another $60,000 policy for a shorter period of time to cover that mortgage. So I've looked at several types of insurance. You need to assess what your need for insurance is. In your financial plan, identify insurance requirements. You may not be able to afford all the insurance you want, but that'd be a great insurance goal. I want to increase my life insurance to a certain dollar amount and give it a time frame. Another thing you can do with life insurance is convert. If you can't afford the permanent that you need, but you could afford the temporary, you can buy temporary and eventually convert that to permanent. Now, the price will go up when you convert it to permanent because that price is going to be locked in. But that's another option that you have there. So, have fun shopping for insurance. Okay, hopefully you understand what risk management is all about now and how you can manage your risk. We focused on shifting risk to the insurance company, and you'll be assuming some of that risk yourself. We talked about some different areas of insurance. We talked about property insurance. We talked about life insurance, and we touched very lightly on health insurance. The property insurance and the life insurance, again, need to be addressed in your personal financial plan. How much insurance do you think you need? When you're putting together your plan, you may not have the resources to buy the amount of insurance that you think you need. If that's the case, you may have a long-term goal. That goal being increase my insurance to the appropriate amount. Or you may want to increase your deductible in order to lower your premiums. One thing to keep in mind, if you increase your deductible, that money needs to be set aside in your emergency savings. So you've got to save that before you can adjust that deductible. So after today's segment, hopefully you have a better understanding of what types of insurance you need and how to determine how much insurance you need.